Hey Bowtie Nation, Joseph Hogue with your weekly stock market update coming to you Sundays at noon before the week starts with the stocks to watch and the stock market news you need to see. And Nation, when I recommended doubling down on cybersecurity stocks on April 1st, it wasn't an April Fool's Day joke, but even I didn't know those stocks would jump 60% in just 8 weeks. That could be just the beginning though, because we heard last week what could be the closest thing you can get to insider information without going to jail, that a revenue boom is coming for these cybersecurity companies. I'll reveal why and my top 5 stocks along with updates to shares of Salesforce, ticker CRM, and one stock that's up over 218% since recommending it last year. First, onto those cybersecurity companies though, because all you out there in the nation know I've been a longtime buyer of cybersecurity stocks. IT spending on security is outpacing everything else, is the one budget item that cannot be cut, and providers are leveraging overall growth into 20 and 30% growth into specific cybersecurity segments. Nation, after AI infrastructure and Ethereum, cybersecurity is the largest theme in my portfolio, with returns upwards of 65% in just these 5 stocks. I've been buying over the last couple of years, but started doubling down in the last 6 months when these companies got hit in that AI software sell-off, some crashing as much as 50% from October. But if you looked closer, as I argued, you saw that AI wasn't coming to replace demand for cybersecurity companies. It was going to shoot it higher. And we got the clearest signal to that earlier in this month when Lee Clarish, head of product for Palo Alto Networks, that's ticker PANW, warned of a 3 to 5 month window for companies to get in front of a coming AI-driven boom in cyber attacks. Now remember, Palo Alto was one of the 2 cybersecurity companies, along with CrowdStrike, that's ticker CRWD, to get inside access to Anthropic's Mythos model to see firsthand what this new model could do. Anthropic has chosen to delay rolling out that Mythos model because of how powerful it has become in finding security flaws in software. Now, think about that for a second. A for-profit company makes the decision not to release a revolutionary product because it could put hackers on overdrive. Palo Alto saw inside that, saw Mythos firsthand. Claridge has that inside information, and he knows what is coming. And then Google, just last week, stopped a massive attack from AI, a mass exploitation event, and warned hackers are already using available tools to exploit software. Even Apple, long believed to be an unbreakable ecosystem, has been warned. Mythos is coming, and it's already found weaknesses hackers could exploit. So that's it, 3 to 5 months before the cyber shit hits the fan. Now clearly, some of this has already been baked into cybersecurity stocks, with my 5 favorites up as much as 71% since those 8 weeks since that April update, but we are about to see earnings coming out for these companies, and that could mean very, very good news on the sales growth. That's because while these companies will be reporting earnings for the first 3 months of the year, more importantly, they're going to be updating expectations for sales and profit across the coming quarters into that 3 to 5 month window. So far, Fortinet, ticker FTNT, is the only major player that has reported, beating earnings expectations by 32% and seeing its stock jump 20% on the day. And this week, we're going to get earnings from Zscaler, ticker ZS, and Okta, ticker OKTA, which I'm going to talk about later in our Stocks of the Week section, then followed by the rest of the pure play cyber names in early June. Now you can see in my main trading portfolio, I've got over $403,000 in just these 5 pure play cybersecurity stocks, and I'm adding more on this. I'll take you through the fundamentals on each, but you can see CrowdStrike and Palo Alto are my largest holdings here, followed by Fortinet, then with smaller positions in Zscaler and Okta. Here I've updated my research on the 7 pure play names: Palo Alto, PANW, CrowdStrike, Fortinet, Cloudflare, that's ticker NET, ZS, Okta, and SentinelOne, ticker S. Now, Cloudflare plays in quite a few other IT segments, but the rest are all cybersecurity all the time, and really your best stocks for that pure focus on this theme. How I did this, I used analyst forecasts for revenue and earnings over the next 2 years, then calculated a 2-year growth rate, so an annualized rate of growth for revenue, then used the expected earnings growth to adjust that price to earnings ratio. This is very important for these stocks, with PE ratios from 23 all the way up to 226 times earnings. These stocks are never going to be cheap, so you have to accept that you're paying for this growth in this theme. So then adjusting by earnings growth, though, helps you see which are the best relative deals on that valuation. Here we see Zscaler is the least expensive on that measure at just 2.8 times on the price to earnings adjusted for growth ratio, with a PE ratio of 51 times, but then adjusted by that 18% annual earnings growth. I like Zscaler and will be picking up more shares ahead of this earnings this week, but it's probably the most at risk if AI is going to threaten the cybersecurity business model. Fortinet is also very expensive at just 4 times on this adjusted PE basis, though earnings growth is slower at just 11% annualized. Where Fortinet cannot be beat is in its profitability, and I'll talk more about that next. Besides being hands down the best product with its Falcon platform, CrowdStrike is also surprisingly inexpensive on an adjusted PE basis. Now, shares might be trading for a stratospheric 174 times earnings, but those earnings are expected to surge 28% this year and next. I like Palo Alto as well, but I still believe CrowdStrike is going to be the largest cybersecurity company within a few years. And that's saying something considering Palo Alto's market cap is still 23% higher than CrowdStrike. It's 203 billion versus 165 billion. So I believe both of these are going higher. But CrowdStrike is going to surpass Palo Alto as the largest cybersecurity company within a few years. But what we see if we dig deeper, a lot of that explosive growth in earnings for CrowdStrike is on its inflection in profitability. Now, looking at the fundamentals, back in February, CrowdStrike was still operating at an 8% loss on that operating margin. And that is typical of a lot of these companies, spending so much on R&D and marketing, those other operational expenses for that growth, that the operating margin is negative on an accounting basis. CrowdStrike has started to turn on that profitability, though, without sacrificing its revenue growth. 22% expected sales growth this year and next, and leveraging that up for 28% annualized earnings growth. It's why the stock has been able to outperform even this group with its 74% jump since April. And while adjusting that price to earnings valuation gets you started in finding the best relative deals here, you do also want to look at that operating profitability because it is a strong competitive advantage for a few of these. While Fortinet books almost the slowest revenue growth, no other company comes even close to its kind of profitability. This company is a cash machine. Palo Alto is a great balance here also between that growth and profitability, expected to book 21% for revenue growth and convert it at a 15% operating margin, though the shares are quite a bit pricier than these others. Now, Okta Inc. does pretty well on the profitability also, though the revenue growth is just fugly here. I still do think that its leadership and identity management that snags it a takeover offer or some private equity interest at some point, though. Folks, the big picture here is that rising tide in cybersecurity demand boom from AI will lift most of these, but my 5 favorites continue to be Palo Alto, PANW, CrowdStrike, CRWD, Fortinet, FTNT, Zscaler, ZS, and Okta, OKTA. Now, I might take another look at Cloudflare at some point, though it is at risk for that AI software apocalypse in the rest of its business, and SentinelOne is easily the weakest in the group here with negative earnings on a non-GAAP basis. I'm going to show you the stocks I'm watching this week ahead of their earnings, including one up 218% since recommending it last year. But if you want to see the stocks I'm buying in real time, join me on the Blossom Investing app with the special invite link in the description. It's totally free to use and helps support this channel, so I appreciate that, and you're going to get to see what over 500,000 investors are talking about in the social feed. So look for that invite link or just scan the QR code here. As Zscaler does start us off with the cybersecurity earnings this week when it reports on Tuesday, with the stock still off 21% this year on that AI software scare, but bouncing 50% off the April low. Zscaler's larger sell-off is from its more focused product lineup in that Zero Trust Networking and SASE, rather than kind of the broader participation you see in companies like Palo Alto and CrowdStrike. Against these fears that its core products can be replaced by AI, growth is still really strong here, with forecasts for 24% this year and 20% next, along with 18% annualized earnings growth. Like we saw there, though, the sell-off and that growth has made this one of the least expensive in the group at just 2.8 times on an adjusted PE basis, and I think those fears are overblown given security demands. That said, management has not done a good job at managing expectations, and the stock has fallen in 3 of the past 4 earnings reports, dropping by more than 12% on both the last 2 reports. Options pricing here is forecasting another 12% move on Wednesday, so it could go either way, but I still like this one long term. And Marvell Technologies, ticker MRVL, reports earnings Wednesday, with the stock up 218% since recommending it as one of the best deals in AI stocks last June at $61 a share. And Nation, you know we've been following the semiconductor supply chain in these names like Marvell, Broadcom, NVIDIA, and SMCI to ride those AI picks and shovels play. Marvell doesn't get as much news as some of these others, but it is set to accelerate growth at 32% this year and 36% next. and to leverage that up to 38% annualized earnings growth. Now, the valuation has come up quite a bit with that run, and management has a mixed record on its earnings here, disappointing the market in two of the last four with an 18% plunge on the Q2 report last year. So I think it does well long term, but would be worried about a pullback this week. And Salesforce, ticker CRM, is going to try to break its downtrend when it reports earnings on Wednesday, with the stock down 20% over the 5-year period and down 36% just in the last year. This is all the software apocalypse theme tied to AI, and Salesforce hasn't gotten the bump higher over the last couple of months like many in the space here. Here with the iShares software ETF, the ticker IGV, rebounding 26% just over the last 8 weeks, while CRM is still down 7% since mid-April. That tells me investors still aren't sure that Salesforce can navigate all this, and it's putting tremendous pressure on CEO Mark Benioff to come through with higher than that 11% growth expected this year. That said, the shares are trading at an attractive discount on valuation and have done well during the previous 2-quarter reports. Now, on this one, I'm actually not quite sure about the long term because I do think that AI eats into some of these software sales, but it could be due for a rebound on any good news. Here, Okta Inc., ticker OKTA, has always been one of the weaker cybersecurity stocks on my list, up just 5% on the year, though it has rebounded 44% since April. The company is a leader, though, in the identity access and management segment, which is a slower growth segment at around 9 to 12% annualized revenue growth, but one where Okta does have a strong market share of 11%, second only to Microsoft. Now, after Palo Alto paid $25 billion to acquire CyberArk last year, which is only a 3% market share on that identity access market, I reasoned that Okta could be a strong takeover target as well, or at least undervalued. Now, the company reports earnings on Thursday with growth of 9% in revenue expected, though earnings are seen flat from last year. The management has done a fairly good job at beating expectations in the past, and the shares have been up in 3 of the last 4 earnings reports, rising by 11% last quarter. With the 44% pop since April, I'm not sure it gets that 11% move the options market is expecting, but I'm going to continue to hold this one on that valuation and the potential for a bidder. Updating our stock market outlook, earnings season is wrapping up, but stocks posting an amazing 28% profit growth from last year is still helping push the market higher. The price to earnings valuation has come up quite a bit since April, not yet in nosebleed levels, but not cheap here anymore either, with around 28 times earnings for companies in the S&P 500 index. Against that optimism for earnings and the 18% bump in stocks to near all-time highs, we're still fundamentally in the same place we were that caused that March and April sell-off. Inflation is keeping the interest rate on the 30-year Treasury above 5%, a point that has always caused stock market pain over the past 3 years. And despite promises that a deal is close, the best we can hope for in Iran is an extension to the ceasefire, which could mean no relief for gas prices. Now, we will see the all-important personal consumption expenditures, that PCE measure of inflation, on Friday. It doesn't get the attention we see with the Consumer Price Index, the CPI report, but it is the inflation metric used by the Fed to determine its interest rate move, so this is where you want to look, folks. Forecasts are for inflation of 3.8% over the last year, on par with what we saw with the CPI earlier in the month. The core inflation number, which strips out the volatile food and energy, is only expected up 3.3%, but that's still way above the Fed's target of 2%. And come on, who are we kidding? It's all about the price of gas, so you just cannot ignore that energy in the inflation reading. So while yes, the AI spending boom will continue, and stocks aren't in that bubble territory just yet, with interest rates above 5% and no sign of relief in gas prices, the hope priced into these stocks short term probably won't hold up. For that reason, I'm still watching for another 3 to 5% correction back to around 72.30 on the S&P 500 before I get too excited about buying anything new here. Join me on the Blossom Investing app, free with the special invite link in the description. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.